Hey everybody, Marty Mazzara. Good morning once again, 5/29, 2018, Tuesday. Thinking about this morning's big global sell-off, anticipating that you may be thinking about it as well. Thought I would bring you up to date on the state of the present correction that we find ourselves in. The chart in front of you is the S&P 500 index. Right here is the high on January 26th. You'll recall we had a really good start to the year and then it all fell apart quite precipitously. Bottomed on February 8th with just over a 10% correction, came back up, then came back down, tested that level again, came back up, and in the process of this back and forth established a real definable downtrend. We had two lower highs. For a while we had lows that were, again, coming down and testing certain other levels. Although we did have higher lows working our way through, so we had what's called a triangle pattern. We actually broke out of there on May 8th and moved decisively higher. Of course, this is the big down day, but we broke through that very definable downtrend with some strength and some momentum and some volume, so it felt pretty good. Now, when you look at these charts, and we've shown them many times over the years, when you have a downtrend or an uptrend, they often get tested. What happens is you have folks here that were trading this downtrend who got burned as the buyers in this case came in and overwhelmed the sellers. Now, as they track this trend line, they're conceivably an opportunity. They're hoping that stocks continue to go down so that they can get back in, because in theory they've realized that this is counter trend within the context of an ongoing bull market, which is the thesis that we are presently operating under. We absolutely think it's very possible, if not probable, that we indeed do go down and perhaps test this trend line at least once before we meander our way to new all-time highs, particularly during the summer months with some of the international and geopolitical issues that we are seeing the world deal with, midterm elections and so forth. Suffice to say, as we've been suggesting, it's going to be a very volatile year, certainly. Okay, so if you accept all that, you might be wondering, all right, so how long on average, since we're talking about how markets tend to do things over time, how long then, historically speaking, should we expect it to be before we move our way to new all-time highs, if indeed we're living within an ongoing sustainable bull market, which is what the data again suggests we are at the moment. The average is 209 days. If you look at all 10+% corrections historically, that's on average. Some are shorter, some are longer. That's on average how long it takes to get back to the earlier peak and then move through that to new all-time highs. So folks, if we look at it that way, we are looking on average out to somewhere around late August before we should really expect to win back those gains that we had at the beginning of the year and move on to bigger and better things. Of course, as I suggested in this morning's podcast, we have midterm elections as well as other things to contend with. Also, as I suggested, we believe there's reason to be optimistic for the end of the year, fourth quarter. And that's based on probabilities and the data as we see it today. Of course, that's all subject to change, and we'll share with you those changes if indeed they occur and how we view things going forward as the year unfolds. So anyway, I just wanted to make this quick for you this morning, give you some context on the correction and on what's normal in terms of markets. We can talk about problems in the Eurozone as we did this morning. We can talk about challenges for certain sectors like financials, which we have a heavy weighting to. But at the end of the day, we could be just talking about normal volatility within the context of an ongoing bull market. And so I'll leave it there for now. Hope you have a good rest of the day and talk to you again soon. Take care.